Hey guys, welcome back to the channel, and in today's video, what we're going to be talking about is a new strategy that I'm implementing on my channel. This strategy is covered calls, and if you didn't know, that's an options trading strategy. And if you hear the term options and you get a little bit worried, you're like, options, no, bad, that's gambling, that's risky, I want to stay away from that. Well, just hear me out and listen to this strategy. And if you are familiar with options trading strategy, it might just be a good little refresher for you, so make sure you stick around to the very end, and let's get right to it. All right, guys, listen, if you are brand new to this channel, just coming here for the first time, well, I want to say welcome. My name is Dalton. This is D-Lits TV, and on this channel, we talk about all things investing. And like I mentioned in the beginning of this video, it's all about covered calls in this one. I actually am setting up my first covered call trade. I'm doing it within Robinhood. I think they're the easiest platform to demonstrate this method. And then it also carries over this concept, really works for any brokerage that you're allowed to trade options within. It's just a conceptual type of strategy, very easy to follow along with. So if you do get tripped up, then make sure that you leave a comment down below. You can rewind, rewatch portions of this video and get all the information that you need. Now, this is a very safe, I want to say, options strategy. And when you're trading options, a lot of people are of the mindset that this is very risky. It's very hard to actually do because it's similar to gambling, where if you don't know much about trading options, you're essentially betting that the stock price is going to go up or down before a specific date. So if you just look at options trading in general to get a little bit of a sense, an understanding of what it looks like when you are trading options, basically you are buying the right to purchase shares at a given price. And that's a little bit hard to follow along with. And I think the best way to explain it is to jump right into the Robinhood app. So let me do that. All right, so now that the Robinhood app is open, there is a number of different things that I want to cover. I'm going to try and break this down as best as I possibly can. There's a lot that goes into it, and it's easy to get tangled up in the weeds. So as I go along, if you guys have any questions whatsoever, make sure you leave them in the comment section. I will try to get back to you as best as I possibly can. I'm just going to scroll down as if I was about to purchase a option, right? I'm about to trade options. I'm going to go into, let's say, Pfizer, for example. If I were into Pfizer, I would go ahead and click trade, and then I'd click trade options, and you're presented with this screen right here. Now, across the top, you're looking at different expiration dates for the options contract. So if I were to go with the earliest date, I would click on March 26th here, and you can see this is the screen you're given. Now, there's a number of different things that you want to take in at this screen to understand, and let me just break it down one by one. Now, in the very center of the screen, you got the current share price, which is $35.99. This is going to fluctuate. It's already down to $35.98. This is the current share price on the stock market. Pretty simple, pretty straightforward. This is what you're going to see when you just click into Pfizer in general to get an idea of how much it's worth. Now, if you were to buy, and options is done in multiples of 100. If you were to buy 100 shares of Pfizer right now, it would be 100 times $35.98, and that's how much it's going to cost you to buy 100 shares of Pfizer. And this is where options come into play, because you can actually purchase the right to buy Pfizer at different prices. And you can see there's prices above the current market price. So the market price is $35.99. You've got these $36 calls, $36.50 calls, $37 calls. You can scroll up and it would keep on continuing up from there. So I'm going to center this right quick. And what this means is I could purchase the right to buy Pfizer stock at $36.50, $37, and so on, going up from there. But I'd have to buy 100 of them if I were to exercise the contract. Now, below that, you can also buy contracts that allow you to purchase Pfizer at below the market value currently. So again, $35.98 is what it costs right now, but you can buy the right to buy 100 shares of Pfizer, $35.50 or $35 or $34.50. Now, from a holistic standpoint, if you just think about it, so we gave you the scenario where you were buying the share price $35.98 times 100. Well, let's say you then bought Pfizer at $34.50 instead. So you just multiply that by 100, and you'd be able to save a pretty significant amount of money through buying 100 shares at a lower price. Now, that's pretty common sense. It's very easy to understand what's going on there. And that's kind of how options work, right? You're just kind of buying the right to buy these stocks at different prices. And again, if you were to exercise the option, it has to be in minimums of 100. So you'd have to buy 100 shares, 200 shares, 300, depending on the contract and where you lie. So let's just think about this conceptually here. On the right-hand side, you're gonna see these values. So you got like from the bottom, $1.51, then $1.01, 57 cents, 24 cents, 9 cents, and 4 cents. So it's not free to do this, right? If you see the market value of Pfizer right now at $35.97, you're like, oh man, I could just buy a bunch at $34.50 and call it a day. Well, it's not that simple. You see this $1.51 here, that is the premium that you are paying in order to be able to buy the stocks at that given price. So you'd have to pay $1.51 to buy these shares at $34.50. But the thing is, you might think, all right, $1.51 is not bad. It's per share. So you'd have to multiply that $1.51 by 100, and then you would have to multiply the 34.5 for what you're buying the stock at by 100 as well to get the total cost. And so you can see that these prices are going to fluctuate, and it only makes sense because as you get like lesser and lesser valued stock, you can see like the $33 call here, for example, is over $3, which is going to come out to be around $300 premium that you need to pay in order to buy the stocks at $33. It just makes sense because you're going to need to pay more to be able to buy the stock at a lower price. And then as you go up, you realize that, oh, you know what? As the price gets more unrealistic, it starts getting lower and lower. So you can see this one is 2 cents and 1 cent as you get further up for that premium. So if I were to say, all right, I think that Pfizer by March 26th is going to be above $36. It might make sense that you click into here, you get one of these contracts, which will give you the right to then buy Pfizer at $36. And you might be wondering, well, why would I want to do that? What does this have for me? Well, basically, if the price goes up to $37 and you're now able to buy it at $36 after only paying $24 in premium, that's a really good opportunity to capitalize on gains. And I know it gets pretty out of hand pretty quick if you're not following along, but I think, I'm trying to break this down as best as possible. So then by the time you hit the expiration date, so the March 26th date that I'm talking about, there are 3 things that can happen to your option. Your option can expire out of the money, which means that the price never was above where you purchased the right to buy these stocks. So let's say you purchased a $36.50 call, and on March 26th, the price of Pfizer was just $36. Well, your options basically expires out of the money and your contract expires worthless. So if you were to buy that today, $36.50, you'd be paying $9. And if it never got above $36.50, this $9 would become zero and you just lose the money that you put in there. But if it was above $36.50, well, this contract would be worth a lot more money. And you could either choose to sell this option to other people or exercise the right and actually buy the full 100 shares of stock that you were allotted for purchasing this contract. So again, that's a lot to take in. If this is your first time hearing about options trading, basically what you want to think about is you're purchasing the right to buy stocks at a certain price, whether it's above where the current price is or below it. If you think it's going to raise by a lot, it makes sense to buy an option that's above where the current price is, and you can actually capitalize on a lot of money from that. But where does this come into my strategy? Because at a holistic view as well, when you look at this, you understand that it's a little bit risky. Essentially, you're gambling. Is the stock market, or this stock in particular, going to go up or down? And there's ways to try and mitigate the risk behind it. And one of the best ways in doing this is trading covered calls. So let me just talk about that and give you a quick example. All right, so now that you know what buying a call option is, well, let's talk about actually writing a call option. Now, there's a stipulation to this, and this is where covered calls come into play. There's a stipulation. You need to own 100 shares of a given stock. The stock you want to do this on, it could be really any stock that you want to do, as long as there's demand and people are trading options for it. You can do this with Tesla, Amazon, Verizon, AT&T, whatever you want. And for my example, I got 100 shares of AT&T. And I'm basically, what is going to happen here is I am going to write a brand new option where somebody else is going to pay a premium to purchase my 100 shares of AT&T at a given price. And so when I do this, there's really 2 different things that can happen. Either one, AT&T will not reach the price that's set, And what's going to happen is I'm going to collect the premium and I'm going to be able to do whatever I want with the premium. That's money in my pocket. I can choose to invest it. I can choose to save it, spend it, whatever I want to do. That's money in my pocket. And if it does not reach that certain price, I get to keep my 100 shares of AT&T. Now, alternatively, what could happen is the price of AT&T could go above the price that's set for the new contract. And in that case, what would happen is I get to collect the premium, I get to keep the premium, and then I also would have to sell the shares to the person if they exercise the right for the contract at the given price. So let's say, for example, AT&T right now is trading at $30. The option contract expires at $31. What's going to happen is I'm going to sell all 100 shares at $30. I'm going to make all of that money. I'm also going to be paid the premium that they used to purchase that option. And then from there, they're going to get the gains of it going from $30 to $31. So they'll capitalize on that. And I miss out a little bit on that opportunity. So there's a little bit of a drawback. You know, if something happens, some big news breaks and AT&T spikes a ton, I'll lose out on some of those gains from that. But really, when you look at the stock chart for AT&T and what's been going on in the past and some of their announcements, there's not going to be huge fluctuations with this stock. It's been downward trending. Now it's been relatively stable around $30. So there's a number of things that could happen, but I'm not too worried about it. All right, so as you can see, we are back now in the Robinhood app, and I'm gonna slow this down a little bit. You can see AT&T right here. I have 100.85 shares. I'm gonna click into it right now. The cost of AT&T at this current time is $29.83. Now, if you look at the past week, it got as high as $30.48, $30.44, whatever. Over the past month, you know, it's dipped. It hasn't been doing too hot, I guess, but it's still relatively stable around $28, $29. Past 3 months, same thing. It doesn't really fluctuate all that much. This is where you can kind of expect the price to be. So here it got up to $33.23 and quickly dropped back down to $30. Now this is relatively stable, again, right around that $30 range. So it'd be really surprising, this is the 5-year chart, it'd be really surprising to see this quickly go back up to $38, $39. And right now, the estimates for AT&T by analysts, just based off of what I know right now, it's around $29 to $38. They don't really know, so it's kind of right in that range right now. And it'll be interesting to see where it heads in the long-term future. But this is one company that I've really genuinely invested for the long term. They have a really high dividend yield. They pay 6.99% right now. Looking at this, that's pretty solid. So I'm going to be getting dividend payments from this. I'm also going to be getting options premiums from this. And let me just talk about how you actually go about writing these new contracts for people to purchase. So this is where things get interesting. If I click on trade, now I click on trade options. Basically, I'm going to go ahead and select a date. I could do March 26th, April 1st. You can see what the prices are going to change. But what you want to do is you actually don't want to do buy for the category. You want to do sell. Now I'm going to go out to April 1st here. I like to do, you know, generally within a week or two. And you can look at this. So if I think the price is going to be below $30, I'm pretty sure about it, I could go ahead and click this. I could do one of these and I would get $26. And this is a premium that would go in my pocket. Again, I could choose whatever I want to do with that premium. But realistically, I could see this going above $30 based on the chart. But I don't see this going much above $31 in the next few weeks. So you can see it drastically goes down. If I were to do $31 call here, I'm only gonna make $6 from this. But this is completely free. It's money that's in my pocket. It's money that I don't have to worry about. And it just kind of adds on to the dividend payments that I'm gonna be paid as well. So there's a number of different ways that you can go about it. You can keep going out further, and you can see the $31 call for April 9th is $10 instead of $6. So if I were to do that, I could capitalize on $10 and so on and so forth. Now, one of the coolest things is you can really do this every single week. You can continue giving people the opportunity to buy these, having them expire a week later, then doing it again, recycling the money, and just use it to buy more and more shares of whatever companies you want. And so when you're doing this, you want to make sure that you're setting a price that's realistic realistic. Maybe it's going to go above this price and you're forced to sell all your shares. Well, where would I feel comfortable taking profits essentially from AT&T? And I could always buy back into AT&T once all the shares sell. But this is, again, just collecting that sweet premium and being able to use it right in your account. Now, for this example, I chose AT&T, but as I said, this could be done with any real stock on the stock market. And the ones that are more volatile, the ones that have more of an opportunity to expire in the money, you're going to be making a lot more money from. So for example, even the ones that are a little bit higher valued. So if I go back out of here, let's say you had 100 shares of Tesla and you wanted to do the same sort of thing with Tesla, you could go ahead, come into this screen and look at that. I mean, if you were to do a $695 call sell, you'd be making $2,035 off of 100 shares of Tesla. Granted, you need a lot more capital to put into this, but it does scale and you have to start somewhere. And so just looking at the chart, I'm kind of wondering where I should position and looking at the news, what I'm thinking is a realistic expectation for AT&T within the next few weeks. Now, personally, I don't see this value above $31, so I'm likely going to look for a $31 call that I could create. And if you look at this, the last time it was above $31 was in December, so there's a chance that it could go back above $31. But if you look before that, it really wasn't above $31 until you're way back in June of 2020. So if it goes above the $31, I pretty much buy AT&T anytime it's below $29. It's kind of a stable rotation here. I don't think it's going to go above that $31 range. So let me go ahead. I'll probably do this April 1st one, look for $31. And again, it's not going to break bank. It's a good starting point. I'm only going to make $6 off of this and I'm completely fine with that. So all I would do is, and I think I mentioned it before, you want to make sure instead of on buy, you're on sell here. Look for that $31 option. I'm gonna do one, and just like that, I'm gonna swipe up. And basically what happens now is you can see my current position is 0 contracts. So nobody's actually bought this contract that I've created yet. The collateral is 100 shares. So basically that's like saying, all right, I have 100 shares of AT&T. And if it expires above the money, I'll be able to sell them and present these to the person that bought it. And from there, whatever happens, happens. Okay, so that's exactly what you're gonna do. Now this $6, as soon as somebody purchases this contract, the $6 is mine. It's in my pocket. Don't need to worry about that $6. It's what owed to me. So looking at this scenario, this is either gonna expire above $31. I'll be able to make a solid profit if it does get up to $31 and I sell, but I don't see it getting much higher than $31. So that's why I was comfortable with this contract. And so although this is small, I do hope you guys see the scalability of it. And if I had more than 100 shares of AT&T, let's say I had 1,000 shares of AT&T, I would have been able to do this with 10 contracts and I would have made $60 from that right there as well. And again, it looks like it's a small amount of money, but every little bit does count and it really does help bolster your portfolio. So again, if you guys had any questions about this process and maybe you're a little bit confused, I hope that I clarified it a little bit for you guys. But again, I will try to get back to every single one of you guys. Thank you so much for checking out this video and have a great day.